February 2015. My name is Nenad, also known as Tarantula, and today I will show you stochastic and MA divergence, and you will see it's a direct continuation to our previous webinar about divergence. But stochastic divergence is used a little bit different than we use for MACD divergence. So I'm sure that you will use this knowledge I present you today to your advantage. Before we begin, our standard is disclaimer. Online educational materials are developed by Admiral Markets AS Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with Forex market. By accepting this disclosure statement, you're also proceeding further with me. Admiral Markets UK Ltd takes no responsibility for information accuracy. The analysis represents the personal opinion of the author. It's me, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not a .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only. This webinar is for informational and educational purposes only. So, with having said that, we are really ready to proceed. So, what is divergence? We talked about it, you remember. If you're not sure what divergence is, then I refer you to visit and listen to Forex Street webinar I did last month. You will see what divergence is. I think that webinar is uploaded, and that is the basics of divergence. Now we need to delve a little bit deeper into divergence to see how we can use with stochastics. Different types of divergence, stochastic divergence, MA divergence, and examples, okay? So pay special attention to this today, because this information can be really, really good and useful when you trade. Now let's just do a quick reminder about divergence. So when we talk about divergence, we know that divergence in that trading sense is definitely the earliest indication of reversal, okay? Is the earliest indication of reversal. We already know that because when we trade, we should not guess, right? Because guessing will definitely give a habit to trade with a gut feeling. So we don't want to trade with any gut feeling, and there is no guessing in Forex market. Some time ago, it's a week ago, I also started to write few things about trading and interesting things about trading on gambling forums, and definitely I use this opportunity to basically say that you should always differentiate trading and gambling, no matter what others think and no matter what others say. If you trade Forex market as gambling, then you're a gambler basically, you're not a trader. But if you add the odds to your favor, when you're stacking the odds to your favor, then that makes you a trader. It doesn't matter if you're winning or losing trader. As soon as you start adding odds to your favor, you're the first step closer to being right trader. So the thing is, when we want to trade, especially counter trend, okay, then we definitely need to use the confirmation for that counter trend trade. Being said that, and having said that, divergence for me, in my opinion, is the earliest indication of reversal. And when I spot divergence close to important support and resistance level, that can be usually a very successful trade with good risk to reward and with small risk, because stop loss is definitely smaller than if we use trend trades. So it's a good sign also to exit a position. So let's say if you are long and you see a bearish divergence, that is definitely a good sign to exit your position if you see bullish reversal. If you are, let's say, short and you see a hidden bearish divergence, that is a good sign to scale into a position. Okay? So it means that you usually buy near the bottom or selling near the top. So we know about it already. Okay? And we know which are different types of divergence we use in trading. So regular bullish, hidden bullish, regular bearish, and hidden bearish. We all know that from previous webinar. Okay? Also, we know that hidden we use for trend trades. Okay? Hidden divergence is only used for trend trades, for scaling into a position or entering a new position. We use regular for counter trend trades and reverse divergence for counter trades. Okay? So today it's a little bit different because we have all of this which I mentioned, but we had basically multiplied it. We will have type A, type B, type C. Okay, type A, type B, and type C divergence. Pay attention. So, first of all, stochastic divergence. Stochastic is a leading indicator. Okay, it is following the price action, and each single indicator which is following the price, following the steps of the price, it's called a leading indicator. The difference between leading and lagging indicators is lagging indicators are momentum and trend capturing indicators, and leading indicators are usually found in trend trading systems, and we use trend or leading indicators to effectively enter a position. Okay, so stochastics is pretty much widely used for entering a new position once the trend is established. Okay, mostly traders use stochastic divergence for entries, but they also use stochastic for overbought and oversold conditions, not just entries and divergence. So basically, stochastic indicator is used for entries, overbought, oversold conditions, and divergence. Okay, that's the typical use of stochastic indicator. I need to say that by default, stochastic has 80 and 20 levels plotted on the indicator itself, and those 80 and 20 levels are two main levels, which stochastic is distinguished from other indicators which also use overbought and oversold conditions. Now, as all indicators, and let's say most of the indicators, we can experiment with it. So we can use stochastic on different settings. The settings which I recommend and most common settings are 533, 833, 835, 4-in-3-3, 4-in-5-5, 8-5-5. Okay, 835 is pretty good in spotting divergence, so 835. But also it's good 833, 855. You can experiment with it. As I say, 835 is pretty much close to being the best of all of these settings. So we have also used, and we have been using divergence for giving us overbought and oversold signals. Overbought and oversold signals are used when we trade counter trend and when we basically want to enter a lower time frame by aligning the momentum. That's another story. We will talk about it when I present you multiple time frame trading and momentum. But now concentrate on overbought and oversold. So when we see that stochastic is effectively above 80, we say that that particular market or the price pair is overbought. When stochastic is below 20, we say that that particular pair market is oversold. So that is how stochastic is used, and mostly when you use stochastic for overbought and oversold conditions, you use it for spotting possible counter trend opportunity or trend opportunity on lower time frame. If the higher time frame has a long trend, bullish trend. Then next lower time frame has also bullish trend, but our entry time frame is having oversold signal. That can be a good spot to enter when the price has already dropped down a bit. And of course we use it with other indicators, but stochastic, no matter what other people say, is really a good indicator. It can tell you a lot. Not just entries, not just overbought, oversold. It can tell you a lot about possible reversal of that particular market. Okay? So, we have three types of stochastic divergence classification. Three types. Type A, Type B, and Type C. Okay? So that is how we classify stochastic. In this particular slide, it says I will use mix of MACD and stochastic example, but I have prepared just stochastic example because MACD can confuse you. So we will use just stochastic examples. Okay? And it's different than MACD divergence. So we have type A regular bearish divergence, type A regular bullish, type A hidden, and type A hidden bullish and bearish respectively. So now let it not confuse you, because the thing is, all standard types of divergence we have already learned are basically type A divergence. So if you visited and if you attended a last webinar about divergence, you probably know all of these types because those are standard types of divergence. But we call it type A because type B and type C are definitely different than these types of divergence. Okay? So, type A hidden bullish divergence. So we can see that the price has made a higher low, but the indicator has made a lower low. So basically this is type A hidden bullish divergence. It's a standard hidden bullish divergence, but on stochastic we always need to connect peaks and see a valley in it. So if this is point 1 and this is point 2, we need to spot that point 2 has given us a lower low compared to this low, and this valley here, look at this valley here, it's a sign that price may start to move to the upside, and this is where we connect it also on the price. So we always use price and the indicator. The price has a higher low. We see a hammer here, so probably this is a good support, and this is an indication that the price will definitely go further to the upside. Okay? And it went. So type A hidden bullish divergence. It's the same for each standard type of the divergence. Standard type of divergence is type A divergence. Another example of type A divergence is a regular bearish divergence. Again, we need to spot 2 points for divergence. Point 1 on the price, point 2 on the price. Point 1 on the indicator, point 2 on the indicator itself. It's easier to spot divergence with stochastic sometimes, much easier than with MACD, because valleys and peaks on stochastic indicators are definitely more pronounced than they are with, let's say, MACD indicator. Okay? So we have type A regular bearish divergence on the chart. Point 1 is this, point 2 it's this one. Point 1 on the indicator is this one, and point 2 is a little bit lower. So regular bearish divergence. Lower high on the oscillator, okay, lower high, and a higher high on the price, okay? And you can see that after some time the price has indeed dropped. It took some waiting, but if you follow trend lines, and we will see moving averages, the price has definitely dropped. But that was the earliest sign that the price will definitely go lower. It was just a matter of time. Now, that is pretty much straightforward. Now we have type B. So for all types of divergence, we can trade any type. But type B is not so good as type A. It's a little bit tricky, but we can spot it. Price is making tops and bottoms, okay? For type B divergence, main thing is that price is making tops and bottoms, okay? So concentrate on this. Price is making tops and bottoms. Type B regular bearish divergence is when price makes a double top, okay, price makes a double top while the indicator makes a lower high. Type B regular bullish divergence. Price makes a double bottom while the indicator makes a higher low. Type B hidden bearish divergence. Price makes a double top while the indicator makes a higher high. And type B hidden bullish divergence. Price makes a double bottom while the indicator makes a lower low. Okay? So concentrate on this. Let's see the examples. What did we say? Price is making tops and bottoms. So we will concentrate on price itself for the first sign of a potential reversal. This is double top, double bottom. As soon as you see double bottom, you need to check with stochastic indicator to see if there is some sign of a potential divergence. So far you all know what double top is, triple top is, double bottom, triple bottom, quadruple, whatever. But I wonder whether you knew about possible divergence. So each time you see double top or double bottom or triple top or triple bottom, please check at your stochastic to see if there is any divergence, especially if you're working with higher time frames. So this is double bottom, and definitely this is a lower low on the chart. Okay? So double bottom and lower low. Hidden bullish divergence. Hidden bullish divergence. What happened is the price went upward after the divergence has been confirmed. So you can use type B divergence not just to give you an early entry. It's also good to give you a good spot on exit. So if you are short at this time, you see double bottom, but you also check with indicators. So you exit your position and you can enter once the hidden bullish divergence has been confirmed, because you traded in counter trend direction here. This was counter trend, and now you're going with a trend. Do not let this chart confuse you. How we define a trend? We need swings. We need higher high and higher low, and then yet another higher high to define a trend. So if this is the low, this is the high. This is higher low, this is higher high. At this point, we say this is uptrend. And if you were following my analysis on euro dollar, 5 days ago, I said that there can be possible long trade on euro dollar. And if you followed my webinar with Admiral Markets yesterday, I have presented potential chance to go long on euro dollar. So if you're intraday traders, it's simple, it's very easy for you to trade the price up and down. I don't say it's easy to trade it. I say it's easy to define a trend. So it doesn't matter. I have mentioned that many times before. For me personally, it doesn't matter whether euro dollar will be on parity in next few months. I am an intraday trader. So if you're intraday traders too, you can go up and down. You can go with both short and long trades during the same day. Okay? That is why I always seek the opportunity to go long and short. It doesn't matter. I have spotted it. I will trade it. So you should do it too. If you're intraday traders, you should do it too. There were many good pips to be spotted and to be taken on intraday charts, both on euro, dollar, and pound. So, again, this is low, this is high. This is higher low, this is higher high. Once this pattern has been established, it's called zigzag, thrust and pullback, classic zigzag trend pattern. You are ready to know that intraday chart is bullish. So at this point you have traded to the short side. Let's say your trade is scalp trade. But here at this point you're ready to proceed with another long trade because you see trend type of divergence. It's type B hidden bullish divergence. And hidden divergence is used for, as we said, trend trades. Okay? Now let's see another type of B divergence. So it's type B regular bearish divergence. So we see it's not a perfect double top, but we can classify it as double top. It's pretty much close to be double top. And we see a lower high on the stochastic indicator. Now, what does it tell you? As soon as you see a double top, you should definitely check stochastic indicator to see if there is a lower high. This is lower high, this is double top, and you're ready to go short. Boyk is asking which time frames you trade intraday. I trade 5-minute time frame, a scalping time frame, but I mostly concentrate on 1 hour chart, and 1 hour chart for me is definitely the best intraday time frame. So I might say it's 1 hour chart, but definitely I pay attention to 5-minute if I want to scalp. But for intraday setups, you can see on this chart, GBP Swiss 1 hour chart. You can see we can chart additional trend lines, Fibonacci, and so on. So definitely 1 hour chart gives me the best insight into intraday trend. And if you want to check my analysis, Boyki, please do it. It can be found on Admiral Markets and also on Forex Factory. It was done on 28th of January, where I presented potential longs on euro dollar. So 1 hour chart definitely is the best, for me, the best intraday time frame. But as I say, you can scalp on 5-minute also. So type B regular divergence. Let's say you're with me on 1 hour time frame and you want to trade intraday time frames. As soon as you spot potential double top, triple top, or double top, quadruple top, it doesn't matter. If you see that the price is topping the chart, you're ready to watch and pay attention to your stochastic indicator. If you see the stochastic has made a lower high, that is a sign for you to be ready to either exit a position or to go with counter trend trade. Okay? And you can see after, let's say, this low has been broken here, or this trend line has been broken, you can see how price proceeded in counter trend direction. Okay? So it's type B regular bearish divergence. We also can spot and can trade type C divergence, which is definitely different to type A divergence, but it's more similar to type B. So instead of price making tops and bottoms, as we could see with type B divergence, now the indicator itself is making tops and bottoms. Okay? So this is when we had price making tops and bottoms. Type C is when indicator is making tops and bottoms. Type C hidden bearish divergence is when price makes a higher high while the indicator makes a double top. Type C regular bullish divergence is when price makes a lower low while the indicator makes a double bottom. Type C hidden bearish divergence is when price makes a lower high while the indicator makes a double top. Type C hidden bullish divergence is when price makes a higher low while the indicator makes a double bottom. Okay? So let's see how it looks on the chart itself. Type C hidden bullish divergence. So we don't now pay attention only on the price. The first thing we should pay attention is our indicator, stochastic. So now stochastic should make double tops. They're rarely triple tops because we use usually only double tops and double bottoms on stochastic. And we can see that this is indeed double bottom. And this valley here is a sign for a potential divergence. So once the stochastic makes double bottom, we should check the price. In this example, we see hidden bullish divergence. Okay, hidden bullish divergence. Hidden bullish, it says price makes a higher low while the indicator makes a double bottom. Is it aligned here? Yes, it is aligned. Price, okay, first we pay attention to stochastic. Stochastic has made a double bottom. Once this double bottom is confirmed, you watch the chart, you watch the price. And what the price is telling you, wow, this is a low, and this is definitely a higher low here at this point. Okay, so this is hidden bullish divergence. And at some point, and we can say it's at this point when the price has dropped and then aligned with this divergence, and the entry could also be made here at the break of this top, and you can see it's a big movement to the upside. Usually, guys, how it goes in Forex market, the bigger the retracement is, the bigger the movement will be in trend direction. So if we spot a trend and then it comes to retracement, we can say that there will be possibly a stronger trend movement after the retracement if there is no reversal afterwards. So when let's just pay quick attention to this chart. So this is definitely uptrend here, right? We have a low here, then we have a high here, then we have another high, then we had another higher low, but then another higher high, higher low, and so on. So this is zigzag trend. Okay? Reversal would be only confirmed if the price has broken through this most obvious swing low on intraday chart. So once swing low on intraday chart is broken, we can say that reversal has started on intraday time frames and it can spread to higher time frames. So for us being intraday traders, we can only say there can be a sign of reversal if this low breaks. Then there will be another cue that the price wants indeed to go lower. Okay? So, if you see type C hidden bullish divergence, you should know that price is ready to proceed in trend direction. And type C regular bearish divergence is, we can say that there is a double top on the stochastic indicator, and we can see the double top is confirmed at this point. And now we go check the price. We can say that it would be ideal if this wick was just a little bit inclined more to the upside. But we can see that price indeed has made, but it can be used like this. So it has made a higher high compared to previous highs, but the indicator is made a double top. So we can say this is a potential sign of a bearish reversal, or at least we can count this as a potential reversal trade. Once this trend line has been broken, we can see breakout, retest, continuation. Look how big drop it was. So no matter if you want to take a chance to trade counter trend divergence trades or counter trend trades generally, you should know that when you spot type C regular bearish divergence, as with all bearish divergence, you should definitely consider exiting a long position. Okay? You should definitely consider exiting because price can reverse. Okay? So that is about stochastic divergence. Yet another reminder, type A type A divergence are standard types of divergence, which we have learned in a previous webinar. Type B divergence is when price is making tops and bottoms. Type C divergence is when, instead of price making tops and bottoms, the indicator itself is making tops and bottoms. Okay? And now MA divergence. Now, you probably are now asking, isn't MA divergence introduced with MACD indicator? Yes, it is. But I do not refer now to MACD divergence. I refer to MA divergence, specifically exponential moving average divergence. It's pretty much straightforward, guys. When you see moving averages like this, how do you call it? Is it a convergence or divergence? Does anyone know how we call these types of moving averages? Are they converging or diverging? If you see moving averages like this, just type the answer if you already know the answer. In the chat, I will see it. So when you see moving averages like this, are they converged or diverged? Okay, I'm still waiting for the answer. Yes, Bontan was the fastest. He says converge. Exactly. So if you see moving averages very close to each other, they are converged. Now, if you see that moving averages go like this, we see that they are diverged because there is an empty space between. Guys, it's the same as with Bollinger Band indicator. When Bollinger Band is making a convergence, it looks like this. As soon as Bollinger Bands diverge, you can see a price movement, and the band starts to diverge. It's the same as for moving averages. Same thing, guys. If you see that moving averages are making DNA spiral, you don't trade it. It's very dangerous to trade. But as soon as these DNA spiral are diverged and MAs are starting to move in trend direction, you see a divergence and you see that there is a trend. Now, what can we say about MA divergence? Moving average crossovers are usually paired with trend lines to give you the better insight into the movement of the market. Because in ranging market, it will do no good. Moving averages in ranging market are no good for you. They are definitely giving you false signals. Okay? Moving averages crossovers are exclusively used with trend lines. Because when you see a trend line and when you see moving average crossover, you know that there is impending trade, that there is a pending exit of the trade. And I will show you how to do that. Trend trades, of course, work the best. Because if you see that moving average moving averages are crossed in the trend direction and that there is a trend line also break, trend line break, you have a double confirmation for your long trade or short trade, whatever you trade. But it works with lower MA settings. Okay? We use it on higher time frames. I do not recommend 15 minutes, 5 minutes for trading this. I recommend 1 hour time frame. I recommend 4 hour time frame, daily time frame, guys. Okay? So we use EMAs exclusively with this. It's my I also did some insights and compared SMAs, then SMMAs, adaptive moving averages with EMAs. EMAs definitely work the best. So we can use 2-5 crossovers, 6-12 crossovers, and 5-13 crossovers. Okay? So, as I say, lower MA settings should be used if you want to spot on MA divergence. Lower MA settings. Now, in this example, we can see basically, we only use stochastic in these examples. We don't now deal with MACD. Okay? We already talked about MACD. So, the price has made a higher high here, and the oscillator has made a lower high. Okay? Stochastic. Higher high on the price, lower high on stochastic. And what does it tell you? It tells you that you have a regular bearish divergence at this point here. So we have a regular bearish divergence at this point. So you're ready to go short, okay? At this point, you could go for a short trade. Look. So if you scalp, you can zoom into 15 minutes time frame, 5 minutes, and exploit the break because you already have at this point a confirmation of divergence. Now you can also see that at this point there is MA cross and you're ready for MA divergence. You can see at these points are only showing you convergence. At this point MA started to diverge. You can also make a trend line also at this point. And you see that the price has made a move, good move to the upside, to the downside, considering this is 4 hour time frame. Now, at this point here, you see that there is definitely another divergence, hidden bearish divergence. So you're ready to proceed in trend direction. And at this point, you see moving average divergence. They are crossing. And at this point, there is a clear sign of MA divergence and trend line break. So this is definitely the safest point to go short. Now, obviously, when you see divergence and MA cross, you can try to trade it. But if you use a trend line and you put a trend line on your chart, there is definitely a chance that you will see a trend line break along with MA divergence. And you can see at this point, MA are diverged nicely, and when trend line breaks, that is your chance to go short. And look how this divergence, MA divergence, lasted until this point here. Okay? So what did you learn from this example? If you're trading the divergence with MA divergence and trend line cross, you can ride a trend after MA converged again. Okay? Use different MA combinations. 2-5 is okay. And at this point, you exit the trade because you have spotted MA converges again. Higher time frames always work the best because higher time frames are giving you a clearer picture, especially if you're trading intraday charts, okay? They give you definitely a clearer picture. The thing what you should always consider and what you should definitely stay away from is so-called EMA DNA spiral. If you see EMA DNA spiral, look like this, you should definitely avoid it. It can be very, very dangerous. Okay? And it looks like a DNA spiral because you can see different crosses and big convergence in it. Remember, it's always better to see MA converged because there is a sign of a trend. If you see that MA lines are converged, that is very dangerous because you can have a lot of false signals. And if you use trend line with MA divergence, your entries are definitely more accurate than if you use just MA divergence. Now, I'm not saying, because especially you're working with higher time frame charts and with higher time frame picture, I'm not saying that you cannot scalp this MA cross with higher high and lower high, which is regular bearish divergence. If you zoom into lower time frame, you can try to exploit it. We will talk about it when I do multiple time frame analysis webinar. But you can try to scalp it. But if you want to trade this time frame exclusively, then it's always good to see moving average divergence breaking a trend line on the price, coupled with stochastic indicator. It can be very powerful. Okay? So guys, now I'm open to your questions. We have come to the end of the webinar, and yet again, do not forget about EMA DNA spiral. Definitely avoid, if you see price moving sideways, if the price moving sideways and MA lines are pretty much stick together, you definitely should avoid it. Forex Boyk is asking, is it possible to receive your slides? I'm not sure definitely about it, but I can copy. If you send me your email, I will copy it and give it to you, so you can use it also, because this is a webinar which I did, and slides itself maybe not, but I can definitely do a copy and send it. So you just send me an email. My email is tarantullafx@gmail.com. You probably know it, so if you send me an email, I will be glad to help you. Okay? So if you have any further questions, of course, guys, do not hesitate to ask me. But I think that it's yeah, I will type in the chat. Okay, so my email is tarantullafx@gmail.com. Okay. So if you tarantullafx@gmail.com. If you need any, of course, help, you can contact me in accordance to these webinars I do with Forex Street. And if you're not sure, I think that this webinar is being recorded and it will be uploaded. If you're not sure, again, how you should spot these types of divergence with stochastic, please refer to, and we have the confirmation from FX Street administrator that this webinar was recorded, and you will find it in our archives. Great. So that is pretty much good, because I know it's probably something new for you, and I probably know that you haven't heard about this before, so it's good to have this sort of webinar uploaded and recorded. Yeah. Ron is saying, thank you, Nenad, excellent presentation. Yeah, you're very welcome, and thanks for comments. Anthony also. Z Buntan is asking, the slide shows the divergence between higher high and lower high. It is okay to use that divergence as entry. When you see divergence between higher high and lower high, that is a cue, a hint that the chart might reverse. But for entries, I definitely recommend using MA cross with trend line break. Now, if you're referring to this divergence particularly, I will use this slide. You can use a trend line here. now don't mind me because I cannot be very precise because I don't have tools for this. But if you see that this trend line breaks and this MA also are diverged at this point, you can use this. You can see that there is an empty space at this point. So MA diverge at this point, but there is also trend line break. So you can use, and look, you can ride the short. Okay? And there is also a couple of different entries I can use with divergence. I can show you that also with in one of our next webinars, which I will make with Forex Street. But at this point, for stochastic divergence, I don't talk now, I'm not talking about MACD divergence. I specifically talk about stochastic divergence. So try to spot it. Try to trade it as I explained here. So draw a trend line, wait for trend line break and MA diverge. You need to see blank point here, point blank, and this is white blank point. It's not point blank, it's actually a blank point. It's a word game. So if you see a blank point, blank, as in this example, you can see it here, okay? That is a sign for you that MAs are diverging and you can take a short trade. Boyk is asking what percentage do diversions work. I don't know because I haven't calculated the percentage, but if you want to take this into your account, start with exiting the trade. So first, if you're long and you see divergence, you exit the trade. It's always the best to exit the trade because it's an earlier sign of reversal. If you want to take the trade with divergence, then I advise you to practice on demo account to see if it's good for you or not. DNA, as in biological DNA, human genome, DNA is a human genome, and it looks like a human genome. You know, genome, human genome, and it looks like a spiral. Okay, so it really looks like a spiral. So please never ever take any trades when you see this, because I know from personal experience and from many traders who were telling me about crossover systems, they are simply very dangerous. That is why we need to use other filters. Trend lines, stochastic divergence, and divergence on MA itself. Okay? Boyk is asking an interesting question again, and I like when you ask me those kind of questions. How do you handle economic data releases and news? I'm really I need to make a special webinar about handling economical data releases and news. And Forex Street gave me an exclusive opportunity, which I will probably use next month or maybe in April. I will use 2-hour webinar to show you how you should trade the news and how you should handle economical data releases and news. And pay attention to that exclusive webinar. We will negotiate about it, and I think that that will be my first 2-hour webinar with Forex Street, and I will be really glad to explain how you can trade NFP, how you can use other news to effectively get you in the trade, how you can use a low volatility, high volatility after the news spikes, and so on. And also in that webinar, it will be explained how to handle the news. It's a little bit, I don't have the time to explain it now, but I will use that opportunity to explain you on that particular webinar. But just for starters, I can tell you, I always look for intraday trend. And if, let's say, just for example, if the pound, for example, is having a long intraday trend, and there is a news which give me the better price. For example, the news was bad for GBP and GBP dollar drops. I use that opportunity to basically get into a trend with a better price. So if I see that GBP news is bad and GBP dollar is going up, GBP dollar usually inevitably falls after the bad news announcement. But I use then the opportunity to get in the trade with a better price. That's just a simple explanation, but I will use the next webinar about news trading to a little bit to delve deeper into that subject. Okay. So guys, we are already over the time. An exit, yeah, exit is different. Exit, I don't use news for exits. I only use news for giving me a better price, because I trade intraday. So if I'm in a profit and there is news coming in 5 or 10 minutes, I will use trailing stop. That is always the safest way to secure your profits, because I don't want to be in a profit and then later to lose the trade. Okay? That will be explained on the webinar, so please be patient. So this is everything I had for you today. Thank you for attending. Sign up for new webinars, sign up for upcoming, and pay attention to exclusive webinar, which will probably happen next month or the month after. I wish you to trade safe, and I wish you also to make many, many green pips. And if you lose, that you don't lose much. Thank you guys. Thank you for listening, and cheers and trade safe.